Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, European rate strategist, and I'm joined today by our global rate specialists, Giles Gale, head of European rate strategy, Blake Gwinn, head of US rate strategy, and Theo Chapsalis, head of UK rate strategy. Hi everyone, welcome back to another Bondcast. A busy week this week, I'd say, focused on supply in quite a lot of ways. We've had a lot of supply again in Europe. The supply events in the US have been big drivers of market moves over the past few days, and also in the UK as well. So before we get stuck into that, maybe I'll go to you first, Giles, because it's a big week, I guess, next week, in that we finally have, well, something exciting on the calendar to talk about in the ECB meeting. Before then, I guess in the face of a couple of big supply weeks now, we've had finally a bigger week of purchases from the ECB in this kind of period of significantly higher purchase pace. What did you make of those numbers this week?
Yeah, as you say, it's the first week that they've really looked significantly larger than what we had before. I mean, I think we're all scratching our heads kind of going, well, what does significant really mean for the ECB? And I think obviously one of the questions was, okay, so maybe there's a reaction function we need to kind of tease out over time about what the ECB is really doing here, about trying to defend financial conditions and so on. And we've talked a lot about those in recent podcasts. Financial conditions actually look pretty okay, which means maybe the ECB actually doesn't really need to do as much as all that. Last week they met really quite heavy supply. I guess associated with coming back from the holidays, the start of the new quarter, and so on, with pretty decent amount of buying. I mean, it was only 4 days. If you gross it up, I'm not sure if you're supposed to do this. If you gross it up to 5 days, I mean, it was head and shoulders above anything that they'd done previously. But I mean, bottom line, they probably bought about half of the duration which came to the market from governments last week, and I imagine they've probably done similar this week. So, the upshot was. Yeah, I mean, it's always difficult to know what the counterfactual, and it really is. But we had quite a strong week in US fixed income, and so a bit of a relative concession for European rates. And I would expect that the ECB, was probably, I think it was a significant part of that. So they're just doing what they're doing. They're dampening down volatility, acting as a bit of a buffer, a cushion, if you like, between supply and the market.
Okay, so we have this meeting next week, and I guess one thing we sort of learned really about the reaction function at the last meeting and reiterated in the minutes was that they've taken a sort of quarterly view, I would say, for monetary policy. We obviously had the beginning of March meeting where they reset purchases at this significantly higher pace. So does that mean that next week we can just expect to be a bit of a placeholder meeting, or is there anything kind of interesting that you're expecting from next week?
So I think that the focus for everyone is going to be the extent to which they are open to maybe stopping this 3-month surge after June. And I expect that they'll probably just duck it by saying, well, it's all contingent on the strength of the recovery and the progress that we're making on vaccinations and so on. We'll make the decision in June, and we'll tell you, we're not going to pre-commit or anything like that. Fine. Okay. I mean, that's, I think, fairly foreseeable, but there'll be lots of questions on it nonetheless. And I think that's really, so I think for me, what's interesting about the meeting is not so much what we expect to really be told, but just that it sort of serves as a decision point, perhaps, for people. We're halfway through now this 3-month kind of surge in asset purchases, and I think that people will be thinking about, well, okay, fine, I didn't want to fight the ECB, but I don't want to wait till the last minute before I put on trades that are effectively fighting them. Right? So now that we're halfway through and we've just had all this messaging, and that's, I guess, a risk event out of the way, how do I feel about maybe having a go at that? And so, for us, and you've heard again and again in the last few weeks, we have this sort of bullish bias, I suppose, relatively weak conviction, really just looking for the right timing to go with this long-term more bearish theme. And we'll certainly be part of the contingent who are looking at that sort of post-ECB sort of days, weeks to pull the trigger on that.
I can't remember if we said it last week or perhaps it was just in John's weekly thematic review this week, but I think he called us hibernating bears, which felt like the right assessment. So I guess we'll be looking for that as a potential turning point in this kind of near-term, more bullish view. The final thing I just wanted to ask, and I feel like we almost talk about this every week, or recently have been talking about it every week on the podcast, but it seems to be in the headlines and has everyone's attention, is on the vaccine story. So obviously this week at the time of recording it, we've had Johnson & Johnson being temporarily halted in the US and now delayed for rollout in the EU. We were expecting doses to be delivered in April in the EU, but that's been sort of temporarily delayed. How are you thinking about that in terms of our kind of recovery assumptions for the latter half of this year? Does this matter? Is this important? Can you just update on that, I suppose?
Listen, I mean, it's almost deja vu, really, and I think we'll probably find a way to get those Johnson & Johnson vaccines, those doses into people's arms, one way or another. I mean, maybe they're not, maybe you have to think about different cohorts and so on. But no, I expect that they will find their way into the market, to be honest with you. No, it doesn't really change anything. And actually, on the other hand, I think we also had the news that Pfizer is going to be making another 50 million doses available in the second quarter. So that kind of, it's a bit of a wash, even if you consider that perhaps there's a risk that Johnson & Johnson doesn't get out in the second quarter, which I think, as I say, is wrong. So I still think that we're talking about there's improvement in COVID trends that we're already seeing now. I mean, infection trends are turning over again in all those most worrying countries in Europe. And I'm really optimistic that this is the definitive downtrend and that that it'll all be better from here. So let's hope that tracks.
I like your optimism. We'll stick with that. Okay, so while we're on the subject of vaccines then, Blake, I'll go over to you because I guess, it was the US that kind of kickstarted this trend on the Johnson & Johnson vaccine. Are you, concerned about that, I guess, from a recovery perspective, or do you really kind of share the same views as Giles that, it's not a huge share of overall supply and ultimately this is probably more of a delay than, a short delay than anything else? And I guess while we're on the subject, perhaps we can just talk a bit about Bullard's comments earlier this week as well. And he said about, a taper can begin once 75% of the population had been vaccinated, because the US is clearly a little bit further ahead in its vaccination campaign than Europe is. So that 75% number isn't that far away.
Yeah, I very much shared Giles' view on this. I don't think it's a major delay. I mean, they've been very clear to say that this is just a very temporary overabundance of caution to kind of check things out. I don't think it impacts the broader trajectory that much. I also think one of the topics that kind of sprung up after that delay was how it would affect people's willingness to take it, and I think it's only really going to be a marginal. I mean, the views on whether or not to take the vaccine are very personal and very come with very strongly held convictions in either direction. I don't think this alone really moves the needle all that much, or at least not to the point where we'd be working it into anything on the economic or market side. So largely a non-issue for us, but obviously merits watching. On the Bullard comments, yes, he gave this kind of a 75-80% level of vaccination rates. But I would want to highlight, kind of the context with which he said it. He didn't, importantly to me, say that in prepared remarks, or, it didn't seem like that was some kind of level that he had been thinking very hard about prior to his comments. It really came in the context of a question and answer session. He said that one of the kind of preconditions to altering policy, one of the things that he would like to see is for us to be at the quote end of the tunnel on the pandemic. And then he was kind of pushed on a follow-up of what did he mean by out of the tunnel, and that's where he kind of pulled this 70 to 80% level for vaccination. So he wasn't really setting this up as a test or a threshold or a trigger. I think it was just his general sense of a level that he thought would be consistent with being at the end of the tunnel. And again, I mean, I think that would be kind of one precondition, but it would not be a trigger. I mean, the Fed would still primarily be looking at the labor markets and inflation data, the reaching that kind of 70 to 80% level, or 75%, I think is what people picked up on. That's not something that would automatically trigger a taper or even a taper conversation. So just to kind of put that into context, and also I would note that it doesn't really change our timeline. If you kind of look at the trajectory of where we're at, we're somewhere around, it's called 25% vaccination rate right now. If you look at that 75% level, that probably puts us somewhere towards the end of the summer. That's kind of when we expected the taper conversation to really pick up anyways. So it doesn't have a big, impact on how we're thinking about the timing and the rollout of the next steps for monetary policy.
Okay. I mean, just going back to what you were saying about Johnson & Johnson and not really changing your view either, I would just kind of reiterate that the evidence that we've seen in Europe from the AstraZeneca fallout is exactly as you suggest. Like, it hasn't really changed the kind of pace of the rollout after it was then brought back into play again. It didn't change the pace, even in those countries where evidence suggested that they no longer trusted the vaccine, etc., etc. So I would agree with you there. Okay, so away from vaccines then, let's move on from that for this week. We also had, last week we spoke about the strong data in the US. We'd had that big NFP number, and this week we've had another big beat on the inflation side, but markets just aren't really reacting, I think, how you might have expected them to two kind of big numbers like that, say 6 months ago. What do you make of that?
Yeah, markets seem really comfortable right now trading sideways. I mean, it does seem like we're getting comfortable in this range. We've got tens in the kind of, let's call it 160, 175 range. It does seem as if the reflation trade, where kind of everything moved higher, that's clearly we moved on from that. It almost seems like the positive data we've received the last few weeks is really, it must just be delivery on those expectations that were priced in so aggressively in Q1. Because as you said, the markets have basically glanced through it. I mean, we had an absolutely blockbuster reading on employment and a very good inflation reading. I mean, if that had occurred a month ago, you would have expected rates to soar, and instead, we've actually rallied a bit. So market's really kind of shrugging off that data, I think, getting comfortable with this range. And to be honest, I think it's something that probably is going to hold for at least a little while. As I said, I think the data, even if it delivers well, is largely just confirming what's already been priced in, rather than being kind of leading to any kind of renewed push on that reflation theme. I think the Fed has brushed off any attempt to kind of write a story around them. That goes all the way back to December, where everybody was talking about how they had to do WAM extension. They needed to provide more accommodation. They said, no, we're not doing it. We get to this year. It was all about, they're going to have to push back against rising yields. They've pushed that story aside. I mean, they've really just stayed the course all the way through. And every time the markets try to move in one direction or the other, either more accommodative or less accommodative, early taper, move on QE or later, they just kind of brush it off. I think they're very comfortable with where they're at right now. I think they're probably going to stay, stay at this kind of status quo for at least a couple of months. If we do get some shifts in communication, it'll largely be on the margins. Maybe some of the more hawkish members start talking about taper later this year or something, but really I don't expect a lot out of the Fed. And as I said, the data is just going to confirm what we've already essentially priced in. So I see this range holding for at least a little while.
Okay, and just lastly on the Fed then, because you said there's not a huge amount to talk about, but one of the things we were talking about at the end of last week, triggered by Lori Logan's speech, was about kind of adjusting their purchase buckets, which I know isn't a kind of monetary policy action. It's not like this RAM extension that you were mentioning, and you thought that might be announced in the schedule that was released yesterday. It's Thursday today. Yes, Wednesday. Sorry, this week. Are you still expecting that, given that it wasn't announced in the schedule on Wednesday, are you still expecting adjustments on that front, or not? Is that kind of taken off the table now?
Yeah. Well, it's kind of interesting. So, and also just for context for some of the listeners who might not recognize the name Lori Logan, she is she manages the Fed's portfolio at the New York Fed. So very important Fed figure. And when it gets to the mechanics of the purchases, I think that the way those tend to work is that the New York Fed really manages kind of the minutia of these purchases. The FOMC, the Fed writ large is going to determine kind of the stance of policy, determine kind of the big picture on those purchases. But as far as the mechanical day-to-day operations, that's really going to fall more to the New York Fed and in turn, Lori Logan. So when she says something like this, that's a very, very strong indication that this is something they're thinking about. So it all kind of sparked off with her saying last week that they may adjust some of the purchase buckets to more accurately reflect changes in the Treasury space that's occurred. One of the big ones, obviously, they rolled out QE program before the 20-year benchmark even existed. We had the inaugural issue of the 20-year in May after they'd already started buying securities. So the way they've kind of structured this, the purchase buckets and everything may not match up to the current path of issuance and outstanding. So she was just saying we could adjust that. We may make adjustments to that. So one thing that I found kind of interesting about that is that that there's been increased talk that maybe even as early as June, the Fed really starts to shift into this talk about a taper of the asset purchase program. It seems very weird to be making adjustments to a purchase program that you just plan on winding down in a couple months. So that was kind of weird. It does suggest that that this program might actually last for a little bit longer than people expect if they're feel the need to make these kind of adjustments. Also, I think really key in there is not only did she call out 20-year, but she also mentioned tips. They've been buying an abnormally large share of tips relative to nominals when you look at kind of outstanding, when you look at issuance. So they've been providing more support for tips than they have for nominals, and I think that's been a big factor in the run up in break evens and the strength in tips over the last let's call it 6 months. We talk all the time about the reflation, the reflation theme, which absolutely was a part of it. But the Fed's also been supporting tips more than they have nominals. So if they were to adjust that and pull back on tips, a big deal. So markets really kind of took this and ran with it. They changed the schedule. They released the next schedule yesterday as we're recording this. So that was Tuesday of this week. No changes, 0 changes. So as quickly as the fervor around those comments kind of built up and everybody started expecting some changes, it kind of died down. I think it's still a live issue. Maybe it was just too soon to put into this. Maybe it was just too soon for this schedule release, and it's something that may come next month. But still, I think something that markets are going to be focused on going forward. I don't think that this just goes away. The fact that Lori Logan mentioned it, is a strong sign that this is something they're thinking about.
Okay, and fun fact I learned about Lori Logan today, just to add into the pod, is that she used to be Blake's boss in his former life at the Fed. So there we go, little fun fact for everyone. So Theo, before we move over to the UK, do you want to just add anything on that front around tips? Because I know that's something that you look at quite closely.
Yeah, I think this is a very important signaling. So first of all, the tips market does trade expensive in different strategy pieces and different analysis that have been published by, for example, the BIS and the work that we've done in general. We estimate that because of Fed buying, there's been a premium baked into break evens, which is fairly significant. We talk about my estimates are in the area of 35 basis points. The BIS piece, for example, did reference something in the area of 50 basis points. So buying of tips and the way that this works, this is very important in terms of support for the reflationary narrative. Now, to the extent that less tips are bought, obviously, you should expect that to have an implication across break-evens, but also front-end break-evens, because this is a part of the curve in the US that gets very much bought by the Fed. And the other point is that that is a part where you have significant illiquidity. And basically, Fed buying absorbs any liquidity that you have in the market. So this is how you realize that you have proper support. Stock that otherwise would less likely be bought now is bought because you have one additional marginal buyer, which is the Fed. So that stock can trade more expensive. So that's my quick comment on tips.
Thank you. Sounds like a theme that I'm sure we will return to then in the coming weeks or months, perhaps. So let's talk about the UK then quickly, Theo. We had quite strong data, I guess, on the GDP front out of the UK this week. How does that fit with your narrative of still being bearish, still targeting that 1%? Is this kind of in line with our quarterly forecast as we were expecting? I'm guessing, well, I know you haven't changed that forecast, but for our listeners, if you could just update them on that.
Yeah, absolutely. I think that the important part here is that we have a very encouraging, a very nice story, and it is that of the recovery. Now, the numbers may be a bit different to what the consensus had been expecting. Month-on-month expectations were for 0.5, we got 0.4. Are we still below growth levels pre-pandemic? Yes, we are. We talk about somewhere around 8% below those levels. So yes, of course, there is some damage still being felt, but let's not forget that, well, we are not back to normal. And there is clearly a way to go. And we are supposed to be forward-looking. Well, that's what we hope so. So are we happy with the bearish view? Yes, we are, absolutely. So the fundamental story is very positive. On the inflation side, we feel that inflation in the UK will be felt, and there is a rise in numbers. We've seen that that rise in inflation being felt in the US. Well, to some extent, this will also be felt in the UK. So the bearish narrative is alive and kicking. And the UK government is very happy to issue debt. So if you add all those points together, well, ample supply of government debt, and if you have better places to invest your money, then I guess the fixed income market will have to cheapen. So 1% it is for 10-year yields.
Perhaps you can just talk about that kind of willingness of the government to issue debt a little bit more, because this week's been a big week. Well, I mentioned at the beginning that it was kind of a big week globally, I guess, for supply, but the UK played its part in that, and we had long end linker and conventional auctions this week. So how was that digested by the market, and you know, is there still for that debt at these yield levels?
Actually, both auctions were fairly weak. And we had only 2 auctions. The norm used to be 3 auctions. So this week we had 2 big long end auctions, the longest conventional bond and let's say one of the longest linkers. I would say, definitely the longest recent linker. So the linker 51s. Supply has been absorbed at a discount. Judging by the price action of today, we can see that indeed, there is pressure in the market, and we can see a pretty aggressive steepening of the curve, everything 230s steepening pretty much because of that supply overhang. So this definitely has got an implication. Do we think that it will matter going forward? Absolutely. And this is the other point, because we've mentioned issuance, and then we've mentioned obviously the big theme, which is the syndication that we expect to happen on the 27th, right? And the test, and what we had this week, it was a test. Well, it shows that yes, supply will be absorbed, but the price need to be right, which means that yields need to rise, curves need to steepen, and to the extent that there is not too eager support from some of the real money and pension investors, then you will have a proper bear steepening of the curve. So stay bearish and tense, and do expect especially the linker market to cheapen.
that sounds like the perfect place to wrap it up here for this week. So we'll stay bearish in the UK, and we'll look out for that syndication in a couple of weeks' time. I'm sure we'll talk about it again before it happens. All right. Thank you everyone for joining this week, and we'll catch up next week. I hope you enjoyed this episode of Bondcast. Please do subscribe to our channel to get future episodes and like it, as this will help others to find it. We also encourage you to follow us on social media to get all our latest content. Speak to you again soon.